Well, if you had told me that oil prices would be cut by nearly half from their peak last year, and that interest rates would be down into the mid-threes from 4.25 at their peak last year in terms of the long-term treasury yield, I would have told you that growth stocks would have had a wonderful end to the year. And of course, that did not happen.
In her first monthly In the Know update for 2023, Cathie Wood explains that the current financial climate is perfect for growth stocks, innovation, and crypto to thrive. Despite Bitcoin trading at below its 200-day moving average and stuck under $20,000, Cathie and her firm have only gained more conviction in the asset class, observing that it weathered the storm that was 2022 without skipping a beat. The truth of the matter is that any assets further out on the yield curve, crypto, growth stocks, and innovation really got battered in 2022. However, Cathie and her firm now believe that with the Fed poised to pivot, the conditions are perfect to see a huge rebound and upcycle in 2023. Make sure to stick around to the end of the video where Cathie explains why that Bitcoin, Ethereum, and other crypto tokens having not put in a new low from the FTX collapse is a sign of things to come and a good indication that we have seen the bottom. Also, only a small percentage of my viewers are actually subscribed. If you enjoy finance content, consider subscribing or liking the video. It's free and you can always change your mind.
In terms of inflation itself, let's talk about monetary policy. So M2 is now down to zero growth on a year-over-year basis, and that's as of November. It does look like November went negative. We believe the negative growth rate will continue, if not accelerate to the downside during the next 3 to 6 months. This is a very unusual period. In fact, in my career, I've never seen it go negative, and I've been in the business for nearly 45 years. So this is uncharted territory. And in fact, the last time we saw meaningful declines in the money supply was in the Great Depression, which was, of course, a very deflationary period. So it's very interesting to hear the Larry Summers of the world hearkening back to the 70s in terms of expectations for inflation. He's ignoring a lot of market indicators, and we'll spend a lot of time on that in a minute. Now, when I say uncharted territory, if you look at the average money supply growth for the last 25 years and the last 50 years, a very long time, the average money growth has been 7% at a compound annual rate. You know, zero, negative, is a huge departure. And we believe highly deflationary, and we're beginning to see that, as I will illustrate as we get into the market indicators. The Fed funds rate went to 4.5% in December, and it does appear that the Fed is determined to take it up again. They want nothing to do with a legacy associated with inflation, and as we've suspected for some time, they are unanimous because there are people like Larry Summers out there saying, you're going to be responsible for another run at 70s style inflation, which was highly destructive. And many times I've mentioned here that the 70s inflation is nothing like the inflation we just experienced. The 70s inflation started in the mid-60s with the Vietnam War, with the Great Society programs, one after another, and then we went off the gold exchange standard and lost all discipline. That's nothing like what we have been through. A massive supply shock, two of them, COVID related, and then the Russia invasion of Ukraine. Very different circumstance. One led to lasting inflation, and this one, we believe, as I've mentioned many times before, will be much like what we saw in the early 1920s after a pandemic and World War I. Inflation collapsed. It actually ended up at negative 15% in June of 1921. And we do believe this year we're going to drop below 2%. And in fact, the bond market believes it. The bond market's break-even rate is 2% for the next 10 years. In other words, the bond market is expecting 2% inflation for 10 years. And this is the Fed's goal. The bond market thinks we are already there. In fact, we believe the bond market will continue to rally, meaning long-term interest rates coming down relative to short-term interest rates, inverting the yield curve. Right now we're at 70 basis points, a little more than that. And it is interesting now to watch the bond market disengage somewhat from the Fed's rhetoric. The stock market has not done that yet. In fact, the stock market is behaving like the Fed is right. The energy sector is reaching for all-time highs, even though oil prices peaked in 2008 and we believe are in secular decline. We'll get into that in a moment. On February 1st, we'll probably see another 25 or 50 basis points, so we will be at 4.75 or 5%. Now, most of the Fed governors are saying roughly 5%, maybe a little bit more, and then we're done. Maybe the Fed will start talking a little bit more about some of the very significant declines in inflation and outright prices that we have begun to see. And again, we'll go into that in a moment. One other thing to note about monetary policy, it's very influenced these days by Keynesian economics and something called the Phillips curve. And Phillips curve basically suggests that if employment is strong, then that will lead to inflation. The history of the last 40 years, however, is the opposite. Employment was pretty strong when you adjust out for recessions, pretty strong for the last 40 years, and yet inflation and interest rates came down quite a bit from mid-teens in the early 80s to 0.5% during COVID. History of the last 40 years does not support the Phillips curve, and yet it is interesting to listen to the Fed say, oh, wow, employment, we got to get it down, otherwise wages are just going to take off and become embedded in the system. That was the 70s experience, but it has not been the experience since then. And we do not believe we're in anything like that environment, as I just mentioned. And now the reason it's wrong is when employment is increasing, employment and output are increasing. If they're increasing in a healthy way, then productivity is increasing as well. And we've had a lot of dislocations associated with supply chains recently, so it's very hard to tell where we're going to settle out in terms of productivity. But we do believe, if we're right on how much innovation is taking place, that productivity is going to start scaling in a surprising way and take the sting out of inflation fears completely. So just wanted to share that with you. Now on to economic indicators. I'll go quickly through this part. We did get the employment report today, and it had something for everyone. For those who think the economy is booming, the unemployment rate dropped from 3.7%, which was revised to 3.6, to 3.5, so back to the cycle lows. Non-farm payroll employment looked stronger than expected. I think 223,200 was expected, but previous months were revised down, so that was interesting. The other measure of employment that I've mentioned on this video a number of times is the household measure of employment. Now, it had been falling on balance since March of last year. And in December, there was a big burst, 781,000. Now, this incorporates more small businesses into the survey. So 1 month does not a trend make. It does not erase at all the gap between non-farm payroll employment and household employment that has built up since last March. There's a 2 million person gap. So the truth is probably somewhere in between. Average hourly earnings came in lower than expected, 0.3, expectation was 0.4, and more important was the previous month, which caused such consternation in the markets, was revised from 0.6 to 0.4, and then we had this drop off to 0.3. Now, part of this is a function of mix shifts. You're seeing a lot of high-profile layoffs in the technology industry. Those are high-paying jobs. You're seeing a lot of the employment growth that we're seeing right now in the leisure, hospitality sector. Those are lower paying jobs. So there is a little bit of mix shift at work here. On a year-over-year basis, the rate is now 4.6%. Last month, we thought it was 5.1. Turns out, I believe it was 4.8% after the revision. So again, at turning points in all kinds of cycles, whether it's activity or inflation, we get a lot of revisions. Most important to me in this report, besides the fact that there was that pop in household, so employment isn't falling off a cliff, but the work week did fall 0.3%. And that is going to have an impact on incomes. It looks like personal income or personal disposable income will be up only 0.1% month to month when you take all these factors into account. That's not very much. We had better hope that inflation continues to slow. Most of the inflation indicators we've gotten in the last 2 months have been better than expected. And the Fed's beginning to mention that, but isn't buying into it yet. So we are in a period, we think, where average hourly earnings on a year-over-year basis are still falling in the 2.5% to 3% range in real terms.